Hey guys, it's Nick here from Nick's Finance Tricks. Today we're going to run through my mean variance portfolio optimization spreadsheet. So if you haven't already downloaded the spreadsheet, just head to the link below and download from my blog. This is the template you should be looking at once you've downloaded it. We've got the assets sheet where we input all of our stocks, the results sheet where we'll calculate all of our results, efficient frontier, sigma, which is the variance-covariance matrix, inv, which is the inverse of that matrix, and ASX list, which is just a current list of ASX listed companies. So this spreadsheet basically determines how much of each stock an investor should hold for the next investment period in order to minimize the variance or risk of the portfolio's returns for that period, given a user-defined target return. The spreadsheet also plots the efficient frontier and the required asset weights against portfolio target return. But we'll get to that. Okay, so let's make a start. I'm just going to use the same stocks that I've been using in previous videos. So start with STW, CCL, ANZ, PRY, and SGH. Okay, so if you're worried that the ASX list might not be up to date, just click this button here and that'll download a current list as of today. And now we can download all the historical pricing data for these 5 stocks from Yahoo Finance with the click of this button. And if you want to come back in a few months and recheck the calculations, you can just click this button at that point and it will just add new data to the spreadsheet. It won't replace existing data. Okay, so now we have all of our historical pricing data in their own sheets here from Yahoo Finance. So we can calculate sigma, or the variance-covariance matrix. So here we have to import the desired holding period duration. We can choose from daily, weekly, monthly, or yearly. I'm going to choose monthly because it's a reasonably fast calculation. Daily can take a few more minutes, but monthly is probably about 2 minutes for a 5 stock portfolio. So we've got the counter down here on the left, 7 out of 15 calculations. So now we have the variance-covariance matrix here for monthly holding period returns. We can go ahead and calculate the inverse of that matrix with this button. That's pretty quick. Normally 9 times out of 10 that'll just use the matrix inverse function, built-in Excel function, but in the rare circumstances where that returns an error or there are near singular values within the variance-covariance matrix, then the pseudo-inverse, the Moore-Penrose pseudo-inverse of the variance-covariance matrix will be calculated. So if you want to know more about the VBA algorithm I used for that, just head to my previous blog post, click on my previous blog post, and that explains the algorithm behind it. So now we've got the inverse, we can calculate the expected returns for each asset. Now that is just the arithmetic mean returns for monthly holding periods. The expected monthly return for CCL, for example, is 1.41%, and when we annualize that, that equates to 18.34% per annum. So now we can optimize. So this is where the user inputs their target yearly return. This is an annual figure, so I'm going to put in 15% for the year as our target. Now that calculates the optimal weights to minimize the portfolio variance for a given target return of 15% per annum, which is equivalent to 1.17% each month. And that gives us a portfolio variance of 2.05 by 10 to the negative 3. and a portfolio standard deviation of 4.53% for the next month. And now we can calculate the efficient frontier, which has just populated this sheet, and we'll plot that shortly so it makes more sense. We'll plot it now, so plotting the efficient frontier. So here we see the efficient frontier for monthly holding periods. So we've got our monthly standard deviation on the x-axis and our expected monthly return on the y-axis, and we can also plot the individual asset weights against expected monthly return. So say we want to achieve, say, 1.5% per month return. To minimize the portfolio variance, we would need each of these assets would need to be weighted according to this graph to achieve the portfolio variance. So that's what that's showing. So that's about it, really. I hope you find this spreadsheet useful. As usual, let me know if you have any issues with it, or if you come up with any cool variations I might be able to implement. And thanks for listening.